Good morning and good evening, everyone. I'd like to welcome you to the panel discussion today. Our topic today is global economic outlook beyond the pandemic. We have three very distinguished guests on our panel today. Willem Buiter, he's an adjunct professor at Columbia School of International and Public Affairs. Formerly, he's a chief economist at Citigroup. Jonathan Wilmot, he's a co-founder of XAI Asset Management. He's formerly a chief global strategist at Credit Suisse. Brian Smedley, he's a senior managing director, and he's a head of macroeconomic and investment research at Guggenheim Partners. I'm sorry. Let's dive straight into our discussion then. Year 2020 is a historic year because of the pandemic. I'd like to ask our panelists to compare the current economic crisis to the past episodes of recessions. What do you think are the unique economic challenges brought by the virus to the global economy? Jonathan, do you mind kicking us off?
Sure. Good morning, good afternoon to everybody. It's great to be here. So this is, there are two or three things that are unique about this. The first is that this is the first time we've had a supply shock as big as this, which brought with it a huge shock to income. It's the biggest, fastest shock to global activity that I think we've had in 200 or 300 years of capitalism. And of course, it's also had a disproportionate effect on the service sector. So to kind of give you a little bit of color on that, I think when we saw what was happening in China, the lockdowns there, we revised our forecast down for global industrial production more radically than we did after Lehman's failed. And then equally, we saw a rather different kind of recovery. So early in March, we were beginning to think about when the fall in activity would stabilize and so on. And we basically took the view that there would be an initial V-shaped rebound concentrated in the production and manufacturing sector, and that's exactly what we've had. So we now see global industrial production is actually slightly above the level that it was before the pandemic hit. But obviously in the service sector, and particularly in the hospitality sector, and airline travel and so on, things are way below. I mean, there's another thing to mention, perhaps we'll come on to later, which is the difference in policy response around the world has made a big difference to the experience of individual countries. So, for example, some emerging countries have seen massive loss of income because policy hasn't been able to restore income, whereas in the US, personal income went up as unemployment plummeted. So those are some pretty unique. The biggest shock ever. It's mostly about services. We've had this V-shaped rebound in production, and we've had a very different kind of response around the world. And income in the US actually went up, while unemployment went down.
Yes, that's a very distinctive feature, because we do see people are accumulating cash balances in their personal checking account while not being able to earn wages. Brian, do you want to take us through your outlook for the maybe US job market? Do you see any interesting development there? Between the short-term disruptions versus long-term scarring in the economy because of this unique feature?
Oh, sure. Yeah, thank you. And let me just start by echoing Jonathan and saying thank you to TCFA, David and Wenzhe. Thanks for having me. It's great to be here. Let me pick up on one thing Jonathan said, which is that that you've got this big boost in U.S. disposable income, even at a time when employment is way down. Personal saving has increased, and that's one of the unique features of this downturn, of course, is the fact that you have had stimulus, but because of the pandemic, there are limitations on people's ability to go out and spend, particularly in the most affected sectors. So I think as we see that playing out in the job market, one of the things that we've observed, as was noted before, we had a very sharp decline in employment. I'm speaking, first and foremost to the U.S. If you look at the fall in April employment on the household survey measure, the decline in April was a 40 standard deviation shock. Okay, so a 6 standard deviation shock is a 1 in 1 billion probability. Okay, so it was, but by the standards of the roughly 60 years of data we have for monthly employment, it was a terrible decline. And so what's happened in the months since April has been a fairly sharp degree of rehiring of the folks who have been laid off in March and April. If the cumulative decline over a span of about 6 weeks in the U.S. was a fall in employment of roughly 16%. As Jonathan noted, it was absolutely enormous compared to past downturns, and then quite a bit of that has been recovered. So we sit right now relative to February's peak levels down about 5.6%. So still very deep by historical recession standards, but a very rapid recovery and rehiring. So if you look into details a little bit more, what we see, and this I think informs where we go from here, that the most affected sectors, leisure, hospitality, travel, et cetera, have seen the most rapid recovery in employment from the lows. But we've seen over the last 6 months, a gradual increase in the share of the number of people who identify as being permanently unemployed. Okay, and that share of so-called permanently unemployed, that rate has been rising much faster than it has in past downturns. But we saw a bit of good news in October where that number actually stabilized. And so that's a very early sign, but it's maybe a good sign. As we look ahead, we're expecting some further softness in activity in the next several months. As I'm sure we'll talk more about, we haven't had any new fiscal stimulus in the U.S. There still is a long tail from the CARES Act because people have saved a lot of that still. But the virus is clearly resurgent. It's going to be a difficult winter, and we don't have any incremental fiscal stimulus, and we don't expect that to come until the first quarter, as we'll talk about in a minute. So I would expect to see a slowdown in the pace of improvement in the labor market. But over the next 1, 2, 3 years, we do expect the more troubled sectors, some of the over-levered companies in the U.S., state and local governments that are really getting squeezed, to continue to have layoffs. But on net, those will be more than offset by the rehiring as the economy gradually heals.
Excellent. That's a very, very interesting outlook. We have this balancing act between short-term unemployment and long-term unemployment rates. Hopefully the short-term catch-up will overwhelm the long-term scarring. Willem, do you want to add any color to this discussion?
Just a couple of things. First of all, what was so unique about this shock is that it was a combined demand and supply shock, right? Yes, it hit supply, but it also hit demand almost instantaneously. And so the impact came from both sides, was so disproportionate and devastating. We've seen also very different responses to the pandemic, ranging all the way from China, which really cracked down on epidemiologically on the pandemic in a fierce and ferocious way, to places like the US, where there was no federal response. The state and local responses were uncoordinated and often quite confused and confusing. And so what we got instead of a direct address of the pandemic was a much more determined assault with monetary and fiscal tools on the monetary and financial consequences of the pandemic. That we've seen in the US, to a slightly lesser extent in Europe as well. And I expect to see more of that, because I do not expect that the European and American response to the pandemic Mark II is going to be any more convincing than it was to the first phase of the pandemic. So I expect that we're going to see additional fiscal stimulus with monetary support in Europe and in the US, but not, as was pointed out earlier, until Q1, because in the US, nothing will happen until the new administration is in place and a workable majority in support of countercyclical fiscal stimulus is found in the Congress. In Europe, the constraints are sometimes the national level, but importantly also at the supranational level, where unless we get additional determined action either by the ECB or by an enhanced version of the supranational fiscal arrangement that was cobbled together in June, right? We will see less stimulus than in the US. So I expect that Europe will be less convincing in this second phase of the coronavirus crisis than the US in terms of countercyclical measures.
That's very interesting. That's actually a nice transition into our next topic, which is fiscal policy, because that's the policy tool that has played a tremendous role in supporting economic recovery until today. And as our panelists pointed out, in this unique time when we have abrupt disruption from the virus lockdown and constrained labor market recovery, and also a drastically different public health responses, and the fiscal policy has kind of bridged the gap in a lot of countries. Particularly, that's the case in the US, very generous fiscal stimulus across the board. So Brian, what do you see in the current US election outcome in presidency and Senate and the Congress? What's your outlook for fiscal policy in short term and long term out of US?
Yes, so it was of course a very consequential week with the presidential election on Tuesday, and voting. The ballots are still being counted, as everybody is aware. But let's just kind of start with a little bit of context on the vote itself, and I think that helps inform where we are going as we head into 2021 on fiscal policy. So coming into the vote, most state and national polls had Joe Biden winning over Donald Trump by a substantial margin. He was up the last polls had him up roughly 8 percentage points over Donald Trump in the national popular vote. It looks like he'll win by close to 3 percentage points over Trump nationally. But also importantly, of the key swing states, Joe Biden was winning by a substantial margin. In some cases, he was up by 8 percentage points. But just an important thing to note is Donald Trump outperformed the swing state polls in the top 17 swing states in every case except for one state. So once again, I think surprisingly to a lot of people, including us, the support for Donald Trump that ultimately transpired was far in excess of what the polls indicated. And that's important because it suggests that while the American voters have rejected Donald Trump in favor of Joe Biden, the country is still very divided. There still is a very large portion of the country that supports Donald Trump, and more so than we expected would be the case last week. So that's point number one. On the Senate, but I do want to say that Joe Biden, I think, will be declared the victor. I think he's going to have a very substantial margin of victory in the Electoral College that will be convincing. I don't think any of the legal challenges that the Trump campaign is presenting or arguing, I don't think any of those will have any merit and any lasting effect on the outcome. So maybe turning next to the House of Representatives, well, let me turn to the Senate, which was the other big focus. There were also expectations that we could see a blue wave that carried the Democrats to a Senate majority. They needed to pick up 4 seats net. It looks like they probably won't do that. They have picked up 2 seats, 3 seats, and I believe, and lost 1. But right now, the Senate looks like it will come down to 2 runoff elections in the state of Georgia. Kind of a unique aspect. Not very often that you see 2 runoffs in the same state in the Senate. So it looks pretty likely that the Republicans will keep control of the Senate by the narrowest of margins after we get the runoff results, which takes place January 5th. So assuming that outcome, let me just quickly talk about the House of Representatives because it feeds into the politics. Okay, Nancy Pelosi and the Democratic majority, they lost several seats in the House in a way that I think surprised a lot of people. And I think if we take the election results in total, it suggests that the American voters, while they were ready to reject Donald Trump, they were not ready to embrace a more liberal, a more progressive, more left-leaning policy agenda across the board. And so as we look ahead, what do we see? I do expect that, you've heard Senate Majority Leader Mitch McConnell sound more optimistic on passing fiscal stimulus in the so-called lame duck session for the next 2 months. I think that's unlikely to happen. I think if you look at the political incentives for Nancy Pelosi, they have shifted. I think she'd probably rather pass a stimulus that's signed by Joe Biden once he comes in than pass a stimulus that's signed by Donald Trump, her nemesis. And I think Trump's incentives have changed too. He doesn't have a lot to work for at this point. Previous to the election, clearly he had an incentive to try to get something done, and I think that's shifted a little bit. So we do expect something happening in the first quarter. I think McConnell and Biden will get together and work something out. It's probably, instead of going to be a starting negotiation of, let's say, $2.5 trillion, maybe in a blue sweep scenario, maybe the starting point is closer to $1 trillion, and it's going to be more targeted than we might have otherwise expected. Sorry, Wenzhe, I think you're still muted.
Yes, I'm still muting myself. So what kind of targeted areas you are thinking of? Is that state, local government support? Is that part of your thinking? Anything specific?
Well, yeah. So I think we will get much less state and local government support under a Mitch McConnell Senate majority than we would have if Chuck Schumer and the Democrats controlled the Senate. So that's going to be a lot harder, I think, for Joe Biden and the Democrats to get. There probably will be some. I think it's going to be focused on addressing the pandemic. So I think there will be more spending on healthcare and pandemic-related issues. I think there will be, which I think Mitch McConnell takes that issue more seriously than the Trump administration has. That's been very haphazard and I think intentionally incoherent on addressing the pandemic. Which is confusing, but reality. So I do think it's going to focus on things like unemployment benefits, addressing the pandemic, and we'll go from there.
Cool, great. Jonathan, do you want to add anything?
Only a couple of things, perhaps. I think Brian's absolutely right. The lesson of this election is that Trump polled worse than his party, and Biden polled a lot better than his party. The country is not ready to endorse the left wing or the more radical parts of the Democratic agenda. But ultimately, they also kind of rejected Trump. And he probably would have won if it hadn't been for COVID. But I think maybe his personality and COVID did for him. So he was maybe a bit lucky to get elected, and he was a bit unlucky not to get re-elected. But of such accidents are history made. So we've had 4 years of Trump, and he will have shifted the agenda quite a lot, and we'll come back to that in a minute. But in terms of how Congress is going to work, I think it's really important to say that in the longer term, the moderates on both sides of the House, and I think Brian would agree with this, are going to have much more influence and more power. So yes, the country is still very divided. It's still very partisan. The extremes of the two wings will continue to rant and shout at each other over Twitter and so on and so forth. But in Congress, I think you have the possibility that it might actually get to work in the normal way. That is to say, where you have hard-won compromises and the negotiations between the more moderate elements of the opposing parties. So the most powerful people in the Senate will be the moderate Republicans if we have this small majority for the Republicans confirmed in January. So people like Mitt Romney or Susan Collins, who's been re-elected, and Murkowski and others will be the people who really maybe determine policy. And another thing that's important for the longer term is that Biden and McConnell go back a long way. They know each other very well. Biden was responsible for a lot of the congressional interaction at the Obama administration. And I think they respect each other, and I think they can potentially deal in Congress. So I think those things are worth bearing in mind. You've got a very polarized country, but Congress, the dynamics are going to be much more favorable for the center. So what does that mean in terms of stimulus packages? I guess I feel that maybe Willem and Brian are right that we don't get a package until next year, but I wonder whether the economy itself and maybe the markets are going to sort of create some pressure for them to at least be having new discussions on stimulus in December. The elements of the three elements that are really important are support for small businesses, support for those who are income support for those who lost their jobs or are still out of work, and support for state and local governments, which are finances which are hurting a lot. So who knows? Congress is a funny animal. You might just get something. But you need something is the important issue. And so we'll know that we need something come December. And so from then on, the discussions will start.
Yeah, comes December is also, I think we're all agreeing there's escalating risk of COVID infections prevailing again. You know, the holiday season can escalate that. And in the winter, people are spending more time indoors, and that's good for the virus spread, bad for our health. So yeah, let's see if either something happens to the virus or the economy or the markets will encourage some dialogue. Okay, great. I also want to move to monetary policy. You know, we have this kind of a bit of uncertain physical outlook, some support, but not a lot support. How about on the monetary front? In recent weeks, the chief economist of International Monetary Fund has written an article, calling the world is in a liquidity trap. The president of former president of New York Fed has said a similar thing on interviews. Do you guys agree with this assessment that monetary policy in developed economies are running out of ammo? And what kind of key developments are you watching out for if that's the case? Willem, do you like to kick us off on that one? Willem, you are on mute. You're making the same mistake.
In much of the advanced economies, of course, we are in a liquidity trap, right? We're at the effective lower bound, or as close to it as the monetary policymakers are willing to go. They could go another 75 basis points down in the US without having to abolish currency, but they won't do so. So we really are at the end of conventional monetary policy. So what's left then? One, unconventional monetary policy. You could go aggressively negative. I don't see that happen in anything except possibly small open economies with a very sophisticated financial system, including all the elements of a digital central bank currency, right? Places like Denmark or Sweden, conceivably Switzerland. I don't see going aggressively negative as an option that will be chosen in the US, in the UK, or by the Eurozone. But that still leaves monetized fiscal stimulus, helicopter money, right? And that remains available. We've been using that. If you look at what's been happening to the central bank's balance sheet, there has been a massive expansion, right? We are likely to see more with, on the liability side of the balance sheet, central bank money. So I can see a further fiscal stimulus funded by purchases by the central bank of additional sovereign debt in both the US, the UK, and indeed in the Eurozone. So we are not out of ammo yet, as long as we are willing to recognize that going negative or indeed targeting the yield curve more aggressively are options. And then that helicopter money is the obvious way to go when you are at the effective lower bound. Remove the lower bound.
I agree with that.
Okay.
But I think that means we have to think a little bit about where the idea of monetized fiscal stimulus can go. And I think the other big theme we haven't really touched on yet, but which I think will be a dominant theme for the next decade or so, in terms of both fiscal policy and more general policy, is that we've had a massive change in the global zeitgeist about how central banks should operate. So they're more concerned with fighting deflation than before. But tied to that, we've had a massive change in the global zeitgeist, I think, on climate change. And I think you now see that all the leading economies in the world, except the United States, have committed in one form or another to a zero carbon agenda. By 2050, sometimes a bit earlier, by 2050 at latest. That includes China, it includes Japan, it includes Europe, the UK, and under Biden, it's going to include the United States, in my view. And so I think one area that you see, and you see little hints of this in Europe, is spending that is designed to help and speed up the transition to the zero carbon economy is going to be politically more attractive, more acceptable than before. So that's one area where I think central banks can help to finance incremental fiscal stimulus. And it's certainly part of the Biden program, some kind of green infrastructure program, not the Green New Deal in its extreme form, but and so on. So I think that's going to be a very important new strand of policy. I mean, in Europe, it's quite extraordinary. The ECB is almost explicitly setting aside, or creating the possibility that they will actually help to fund green infrastructure spending directly or indirectly. So I think that's important. Just in terms of the kind of room for fiscal expansion and the question of what you do in a liquidity trap. One thing that is
Jonathan, I think William wants to follow up with that point.
No, this was just on the environmental point. Mark Carney, when he was governor of the Bank of England, of course, launched this massive initiative where he made environmental awareness and awareness of the climate change risks, right, part of conventional finance, right? It wasn't just the green hearts that would have to worry about it. Even if you are just interested in the conventional bottom line, right? Carney's point was that you then really should be paying serious attention to climate change and environmental considerations. And this particular line of thought has continued under Andrew Bailey, his successor, and it has really, as you point out, become the dominant mode of thinking of the ECB, which I think is going to go green in a major way, and which could be combined with carbon border taxes in the EU to make for a powerful, potent environmental mix.
That's very interesting. I also feel the very strong emphasis on green spending and taking green spending as part of the policy framework in Europe. There's a big focus there. And compare that with the US, I think the focus is slightly different at the zero lower bound.
Yeah, but that should change now, right?
Yeah.
After all, the one thing that Biden will do, will be able to do as soon as he sets foot in the White House, is to rejoin the Paris Club agreement.
That's what he said. Yes. Yes. And yeah, let's see if he can get the green spending financed by the Fed. Brian, yeah, I was going to say the difference between maybe the US and the Europeans' commitment to green spending as part of the policy framework is slightly different. We will agree on that. What's your take on the zero lower bound kind of strategy of the Fed at this moment?
Sure. Yeah, I mean, we've had Fed officials discuss the importance of addressing climate change, but I think we're behind where folks in Europe are on that. So I agree with what's been said. But let me just speak a little bit to the idea of being in a liquidity trap and how the Fed has operated in this downturn. I mean, we started this pandemic with the federal funds rate, I think around 1.5%, the Fed already having cut several times in 2019. And so, you know, in their effort to prolong the expansion, they ended up with a little less policy space than they might have liked. But let me just talk about what they have done, which I think has really surprised on the upside. And they've done it in very rapid fashion. And I think it's been overall very effective. So I think I would point to three kind of main channels that they've operated. One is on the kind of more traditional monetary policy tools. Of course, they took the Fed funds rate to zero. They were very aggressive and early with asset purchases, QE. Just as a reminder to folks, there was a time in late March and early April where the Fed was buying $500 billion a week in treasuries and agency mortgages. So just a huge number compared to past asset purchases. And obviously the market required that because markets were dysfunctional, but it revealed that that bond market functioning is too big to fail. The Fed will not allow dysfunction in the treasury market, the agency mortgage market, or the investment grade corporate bond market. That is, I think, kind of something new that we've seen in a powerful way this time. So they continue at $120 billion per month in purchases, and they have some scope, as was noted before, they have some scope to either increase the size or lengthen the duration, the mix of purchases a little bit. And I think they'll ultimately arrive at that decision to upsize the program. But I would say the second tool that I would identify is tools to address broader financial conditions and liquidity and credit market functioning. So that you have a whole range of liquidity programs, some of which were brought over from 2008, and some of them are brand new. I think most folks, if you surveyed this audience a year ago, most people, including myself, would not have expected the Fed to unveil, a municipal lending program, a small business lending program, a Main Street lending program, and a corporate bond primary and secondary facility. So I think, they've really surprised on the upside. They were very creative, and they did it under extreme duress, working from home, and did it in a hurry. So I was impressed with that. But also I would say they haven't needed to spend, quote unquote, much money in the emergency credit facilities, because the announcement effect has been so powerful that financial conditions have really, I don't want to say normalized, but have reverted mostly to pre-crisis. And then the third area that I think deserves a quick mention is on the regulatory relief side. The Fed is, among the primary bank regulators. They have primary jurisdiction in regulation of bank holding companies. And so they have eased regulations on several dimensions to try to help facilitate the flow of credit from the banking system. So I think that's been important as well. So it's a coordinated approach. It's happened very effectively. But where do we go from here? I think, the Fed, it deserves a mention to, the really seminal shift in the reaction function that was unveiled at the Jackson Hole Symposium by Chair Powell after the framework review. That's a really important step, but I fear it comes after potential growth has ratcheted down over decades, nominal rates have ratcheted down, and inflation expectations have ratcheted down. So now we sit at a difficult juncture where the Fed has had a powerful effect of driving real interest rates into negative territory. 10-year real rates were roughly plus 1% at the end of 18, and now they're roughly minus 1%. That's been a very important, tool, a very important, powerful effect. But the challenge is, can they go further from here? And I think the bond market, the TIPS market, is telling you the bond market does not believe the Fed can achieve its stated inflation objective as we look out to the medium term.
Interesting. We just have a signal from the market's consensus regarding the zero lower bound and the future of Fed policy, at least. Okay, let's move swiftly to the next topic. Contract to the zero lower bound. In developed economies, China is at a very different place. It has made a tremendous recovery from the pandemic recession, and economic policy has returned to neutral. Interest rate of the government bonds there is about 3% compared to below 1% in the US and negative in Germany. So do you guys think China is an attractive market to a global investor? William, do you want to go on this one? And what do you see as risks? Of course, it's always a risk-reward calculation.
Well, clearly, China is a massively attractive market. It is, as a market, in terms of GDP or trade shares, it is the size of the US now, right? And so since I do consider the US to be an attractive market, I certainly consider China to be an attractive market. And it's expanding rapidly. I mean, Q3 growth at 4.9% was nothing to be sneezed at. And we are likely to see more, should more be required. China has obvious ammo in the monetary and fiscal policy tanks because they have done much less in terms of monetary fiscal stimulus than the US and Europe, because they needed to do much less because they directly addressed the pandemic so much more effectively. So the main risk, of course, with investing in China is that is the conventional one that the renminbi is not yet fully convertible. And so you always have to ask yourself the question, when I put my money in, right, will I be able to get it out on terms that I consider to be attractive? I think that that will remain an issue. I don't think China is ready yet for a move towards unconditional, unrestricted convertibility of the renminbi. But at the same time, I also don't think that they're going to do anything crazy or self-defeating. So I would consider China in the next year or so to be a very attractive destination for investment.
That's interesting. I think we're running short of time. We have 2 more minutes left. So Jonathan and Brian, maybe you can give us your take on this question, or if any concluding remarks you want to make.
Brian, do you want to go first?
I'll be very brief. Sure. Thank you, Jonathan. I would just say I agree. I think China is a very attractive investment destination. And I would also note that global investors outside of China are very underweight their exposure to Chinese assets. So there's clearly an opportunity over time for money to move into China. But I would say, I think that will happen as the institutional framework continues to strengthen and develop over time.
I think my 2 cents worth is that the Chinese have done a great job in managing the economy through this virus, and it doesn't need a lot of fiscal support at the moment. But I think that we're about to go into a bit of a double dip, or not as deep as the last one, but a bit of a dip in activity in the rest of the world. So that will impact on them too. I think the Biden administration will also be tough on China. I don't think that's going to change particularly, and that does mean that there are a number of things that are going to affect how Chinese policy and how the Chinese economy operates. There's going to be a continued drift away from investing in manufacturing capacity in China. There will be the effect of trying to build their own semiconductor industry with hundreds and hundreds of billions of investment. That's all going to be extremely interesting. I think if one has a market takeaway from this, I think our tactical models, our AI models and our smart expert system models are starting to go underweight equities in the short run, which is a sign that we think there's going to be some slowdown in this global recovery as we manage the winter wave. But I'm still pretty optimistic, both for China and for indeed US equities for the second half of next year, once we get vaccines and get better at managing the pandemic on the ground through rapid testing and the like. Okay,
great. I think that's a great optimistic note to end our discussion. I'd like to thank all our panelists for this excellent round of back and forth. And I will hand it over back to David for the next session.